We're unpacking the source material from December 17th, 2025. This was the day the market slammed into what analysts are calling a wall of reality.
It really was.
That immediate, painful shift from the AI hope phase right into the show me phase.
Yeah.
We need to figure out what sparked it.
And the spark was, well, the signal is impossible to miss. The S&P 500 slid 1.2% to close at 6,721.43.
Its worst session in nearly a month.
Exactly. But the real tell, the moment of panic for anyone in this space, was seeing the tech-heavy Nasdaq just crater 1.8%.
Wow.
That drop confirms a huge psychological shift.
Yeah.
I mean, investors are no longer underwriting 2027 dreams with 2025 money.
Which brings us to the core problem, right? The AI infrastructure shakeout. For 18 months, you just got rewarded for spending on GPUs.
Just for spending. And the skepticism that finally took hold today focuses on what they're calling the capex to revenue bridge.
And that bridge is starting to look unstable.
Very unstable.
Yeah.
The assumption was that all this massive spending on hardware would just automatically translate into high-margin AI revenue.
And when that assumption breaks down, especially for the second-tier players, you get today.
You get today. And you get a very specific failure that kicked it all off.
The Oracle news?
The Oracle news. Reports that funding talks between Oracle and Blue Owl Capital for just a massive $10 billion data center project. They stalled.
And Oracle shares just plummeted on that, down 5.4%.
The sheer size of that deal, $10 billion, that's what spooked the institutional money. The read-through is critical here.
If a giant like Oracle is struggling to get financing,
Then the underlying demand for the core hardware, for Nvidia's chips, which fell 3.8%, it all suddenly looks extremely fragile.
and that nervousness, it just bled right over into the neocloud space, didn't it?
Instantly. And for listeners, neocloud just refers to those smaller, independent guys renting out scarce GPU power. They're built on debt.
And the poster child for that whole model, CoreWeave?
Sank 7.1%. They got hit with fresh criticism on their debt levels, rumors of build-out delays. This is where the macro picture really bites.
Right, because this wasn't happening in a vacuum. The November jobs report was fully digested today, and it triggered a growth scare.
Unemployment ticked up to 4.6%. That's the highest since July of 2021.
So the Fed cuts rates for the third time last week, which should be bullish.
But it wasn't. The market saw the job weakness and decided the Fed is actually behind the curve, not ahead of it. The whole soft landing story just got a lot weaker.
Okay, so if you're watching the tape right now, where do you focus? Let's talk technicals. The S&P is testing its 50-day moving average.
That is the line in the sand. You need to have a laser focus on the 6,700 level on the S&P.
The major support level.
Huge. And if we break that decisively tomorrow, the source material suggests the next stop is way lower, maybe near 6,450.
So the era of complacency is just over.
Absolutely over. Which brings us to the most urgent thing for the next 24 hours. The market is demanding proof, and everyone needs to watch tomorrow's inflation data, the CPI and PCE.
So we're in a true price discovery phase.
We are. The blanket, everything AI goes up mentality is gone. It's about cash flow now. It's about quality.
Okay, stay nimble out there. And here is the final provocative thought for you, and we're pulling this directly from the source material. If that inflation data tomorrow comes in hot, if inflation is still sticky, this growth scare we have now could very quickly turn into a stagflation scare.
And that, my friend, is unequivocally described as a far more dangerous animal for this market.